This series is supported by Apollo Global Management, a leading provider of alternative asset management and retirement services solutions. Apollo seeks to provide clients excess return at every point along the risk-reward spectrum and is focused on empowering retirees, building and financing stronger businesses, and driving a more sustainable future.
You can't be afraid of failure. As we think about innovation and product development, and we think about just creating cutting edge strategies on behalf of our clients, you could have some of the best ideas, but they might not come to fruition. So one of the things that I've learned on a global wide basis is not to be afraid of failure, and you have to embrace it. And what I mean by that is you need to understand that if you failed, what is the rationale behind that failure so you don't do that again, and you got to learn from that.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Jason Singer, who is partner and global lead for product development and innovation in the Client and Product Solutions Group at Apollo. Prior to joining in 2021, he worked at Goldman Sachs Asset Management for 22 years. At GSAM, he was managing director and global head of product, leading the public capital markets team within GSAM's retail client business. Welcome, Jason. Thanks for joining me today.
It's great to be here. Thank you so much.
Well, let's start with your background and career journey. Can you start with where you grew up, what you studied, and how you came to enter the world of finance?
Oh, absolutely. Hopefully we have a lot of time to speak about it. But I grew up in Brooklyn, New York. I went to Syracuse University where I majored in finance and entrepreneurship. And I was very lucky that post Syracuse, I was able to join Goldman Sachs, where, as you mentioned, I spent 22 years at Goldman Sachs. I performed many roles there. I think I was in a total of 9 different roles, where most of those roles I was on the fixed income team, namely as a trader and portfolio manager. But I was really super lucky in my career, where for 7 years of my life, I lived in London, running the non-US business for short duration and liquidity products. So overall, when I think about my time frame, had a lot of experience and just really a lot of fun between New York and London. And then when I came back from London, I was leading our wealth segment on behalf of fixed income. And then, as you rightfully mentioned, more recently, I've been at Apollo for a little more than 2 years, where I lead our product development effort, as well as client portfolio management for our wealth segment.
Well, let's go back a little just to that college focus, entrepreneurship. So you don't have to disclose your age, but give us a feel for the backdrop to that degree. Was this kind of post.com 1.0, where there was a lot of excitement around entrepreneurship, et cetera? And was there anything from that you incorporated into your finance role?
Right. So, in terms of that, as you could see, I'm a little follically challenged. So I guess you could tell, more of my age group. But in all seriousness, I think when we look at everything we do, at least everything that I've done, be it on the fixed income side, be it on the product side, or be it in my current role, we're running different businesses. In one case, it was a fixed income business. In today's environment, it's really a product development business for our wealth segment. But what entrepreneurship has taught me is how to think about an entire ecosystem of a business, where you have products, you have clients, you have client service, you have infrastructure, and you need to make sure that the entire ecosystem is humming and humming well in order for the business to operate correctly.
I also think it teaches perhaps a willingness to kind of create from scratch as well and not be dependent on existing structures. So certainly as we look at solutions and what that means, it'd be interesting to think how innovation comes into that. So moving into solutions now, and your current role has solutions in it and the group has solutions in it. Can you just tell us a little bit about what that means to you, where it starts and finishes, and how that concept of solution building is developing?
Right. So I would say that the starting out point to your question is, what is a solution? A solution has to be, what is the question? So at the core of what we've done is by polling and working with our clients in terms of what are their pinch points, what are their concerns. And when we look at what we're doing over here, a lot of the concerns are around that when you look at traditional capital markets and you think about just plainly a 60-40 portfolio, I think last year was the beginning of the fact that a 60-40 portfolio has not performed well. And from our standpoint, when we look at the go forward return expectations, we do believe that 60-40 portfolios are going to be more challenged. So what does that ultimately mean? That means that we do believe that clients have to have different types of alternatives within their broader portfolio to try to generate better outcomes on behalf of their clients. So overall, when we look at our journey here at Apollo and here within the wealth segment, we're focused on trying to bring different solutions for clients across a spectrum of asset classes. So we're going to have a couple of strategies to help clients build better portfolios with regards to credit, a couple within real assets, and then lastly, a couple within equity and equity replacement options. But overall, the solution that we are striving for every single day is how can we help clients build better portfolios, which will lead to better asset allocations, whereby you'll be marrying both public stocks and bonds with private risk together, we think will lead to better outcomes over a full market cycle.
How do you observe that clients' needs are changing at the moment? What's on their minds as you engage in these conversations with them?
I think clients, their needs are how can they get a portfolio of consistent and persistent returns? And other clients are looking for different types of attractive income opportunities. So overall, I think that when a lot of the clients that I'm dealing with, I think clients are confused. I think clients are concerned. And I think clients are trying to figure out that when they look at the next 5 to 10 years, how can they look to generate consistent and persistent returns? I would say that's number one. I would say number two, from a structural perspective, and I think you're seeing this in the whole democratization of alternatives, you are finding that more structures are coming about. And those structures are allowing clients of different income levels, different suitability levels to gain exposures to different risks. And I think that's what's so interesting and so exciting in today's environment is around the fact that clients are going to have more choices. And these choices, from our standpoint, should lead to better outcomes. And better outcomes should be more consistent returns, more stable volatility, as evidenced by higher Sharpe ratios over the next market cycle.
And we talked before this just about your travel schedule recently, which certainly took in many continents and sounded very exciting. How would you say that that picture of client demand is different around the world? We mentioned Latin America, Asia. Do you find this focus on income is pervasive everywhere, or are some regions more focused on, say, inflation hedging than others?
I would say that the themes right now, there are 3 themes that are universal across all my travels. I think, and not in a particular order, but number one being clients are looking for good income opportunities. Number one, especially with the repricing of the Fed and other central banks. Number two, I think a lot of clients are concerned about inflation. Not that inflation is going to be rampant, but that inflation is going to be a lot more persistent in this regime than it had been over the last 20 years. So clients are looking for ways to earn real rates returns that are positive and mid-single digits on a positive. So we are finding that clients are looking to either allocate to inflation protection types of securities or are increasing their allocations to inflation protection allocations. And then I think last but not least, there is a lot of concern out there around equity returns on the go forward. And we are finding that the clients are looking at different equity replacement options, given the fact that equity returns most likely are going to be lower with a lot more volatility. So just to sum it up, it doesn't matter if you're in Latin America, if you're in Europe, if you're in the US, or you're in Asia, I'd say just more broadly defined, clients want better income opportunities. They're looking for inflation protection, and they're looking for different options on the equity side than just public equities.
And let's move from the output of the sausage machine of product making to the machine itself. Given you've been in this business for 20 plus years, you've probably seen quite a bit of evolution of our industry. And one of the themes that I've talked about before on this podcast with a consultant who consults to asset managers is that he sees the asset management business as shifting from a product business, product focused, to a service business. And I think all the solution building practice is related to service. Would you agree with that? And how do you see that that is changing? And equally, does time to market need to be faster now too? Do we need to be more innovative and more responsive?
Certainly, we need to be more innovative and more responsive. And I think to your earlier point, it's all of the above. I think when we look at the evolving business, you need 3 things. you need to have at its core really good products and diversified products. That's number one. Number two, we need to have phenomenal client service because you can have the best product, but if it's hard for clients to access it, it doesn't really matter. So we need to ensure that we're able to remove the friction with clients to consume strategies. And then last but not least, and I think this plays so well to the alternative space, is education is paramount. Like in this world, as we're advocating to clients to not just look at public stocks and bonds, but to add alternatives as part of your broader asset allocation, there is no free lunch. So as part of that, what is the benefit of alternatives? The benefit is we believe that you could get excess returns over that of public markets with lower volatility. But what is the give up? The give up is liquidity. So a lot of our clients need to pare back some of their risk from, let's say, daily liquid mutual funds or that of ETFs to more of, let's say, quarterly redeemable products or even closed-ended strategies. So when you think about this journey, clients need education in terms of what are the benefits of alternatives, what are the pros, what are the cons, and what are the net benefits at the end of the day by including alternatives as part of a broader asset allocation.
Talk about two things there before we move to alternatives. You mentioned client service, and then the second thing is education. So starting with client service, you've been at Goldman Sachs, now at Apollo, both organizations known, I think, for their exceptional go above and beyond form of customer service. Do you think now that you're, I'm sure, hiring the next generation of customer service, client service professionals, do you think that that type of a person that delivers this level of service is born or made?
I think it's both. I think you have to want to do the job. And then I think you need to be mentored by people on how to do the job and do the job well. I think about this when I look at, both institutions that I've been at, and people ask me, what is success? I think ultimately at the end of the day, we're looking for excellence and not perfection. So when I think about client service, you want individuals that A, like to be with clients, B, understand our product set, and C, they have that drive and that passion to want to do good things for their clients, right? So that's overall. So I think you have to be born, but I think you also have to be trained. But I would also say the other aspect of client service, and this ties into probably more innovation, is around that you need to make the process easier, smoother, to my earlier comment, for clients to be able to consume different strategies. So I'll just give you an example, which was a couple of years ago. If you wanted to buy a classic closed-ended strategy, you would get documentation that might be 50 pages deep. You probably would have to work with an accountant to figure out what to fill out, and you probably still did it incorrectly, that they would need to call you back to try to fill out correctly. In today's environment, with the advent of online subdocs, as an example, it's more of a click and point. So you go from a couple of hours of trying to fill out a subscription document to now you could do it all in 5 minutes. So that's just another example from the technological standpoint of making the experience frictionless for clients to consume the classic closed-ended products. Similarly, when we think about innovation, you are seeing a massive movement to more of open-ended strategies on the alternative side. So think about quarterly redeemable strategies. We have some strategies on our platform that are interval fund-based. So these are strategies where clients can buy it just like a mutual fund where it has a ticker. It's click and point. You could go to your account, put in the ticker, and you're able to buy it on any single day. So again, thinking about the client service on the people side and the technological side, these are the advancements we need to continue to create a frictionless experience on the go forward.
We're going to take a short break to hear from the supporter of this series, Apollo Global Management. I sat down with Joe Moran, Managing Director, Institutional RIA Sales at Apollo. I asked him how Apollo's clients' needs were evolving.
Well, as public markets have become increasingly indexed and correlated, and the traditional 60-40 portfolio continues to face challenges, Apollo is focused on providing excess returns for clients with differentiated alternative solutions across the risk-reward spectrum. Investors need efficient access, and Apollo continues to build out its distribution capabilities, targeting wirehouses, family offices, private banks, RIAs, and more. And
now, back to the show. And do you find, just still on that training point, the mentorship that you said is part of the development of that professional, the listening piece, I'm sure that is paramount importance, the ability to listen to clients and deduct their needs from that?
Completely. As I mentioned in one of my earlier remarks, when we look at our entire product strategy, it's putting the client at the center and asking and spending time with our clients on what are your pinch points? What are your concerns? What strategies are you looking for? How are you looking to consume this? How are you going to educate your clients about the roles that alternative plays within a portfolio? So I think you're absolutely right, which is when I think about our product strategy, it was born out of our clients' needs. And I think on the go forward, that as we think about innovation across the landscape, the majority of this is going to come from our clients' needs and for us trying to solve any of those concerns for clients as we go forward.
Just moving to education, because you mentioned how important education is, particularly in a perceived, perhaps, area of complexity like alternatives. And you, of course, have Torsten Slok. I've enjoyed his presentations and his newsletter. I've attended many of your webinars. How have you found that education cadence needs to be? And for example, what's the time frame that you need to build in? And do multiple touch points, multimedia deliveries? What would be your recipes for success there? Because I think it can take time. The learning curve is real.
I think it takes time, and I think every market is a little different. Well, some are more advanced, some are a little less advanced, but education is paramount. I would say here at Apollo, one thing that we've done to really be a leader in education is a little over a year ago, we launched Apollo Academy. You just go to www.apolloacademy.com, and it's the central source of education. We don't speak about Apollo products. We speak about different markets, and we have modules that are modulated by professors about what is private equity, what is private credit, how should we think about liquidity within these strategies, and so on and so forth. But that is our commitment to our client base, whereby we want to be a market leader from an educational perspective. And I'll give you a little stat, which is we have over 10,000 clients that have subscribed to Apollo Academy, and the average usage of that is nearly an hour and a half. So if you think about it, in this day and age, right, we all get itchy. It's hard to stay still. We're super excited by the fact that A, we have so many subscribers in a short period of time, and B, that these subscribers are willing to learn and to be part of the experience for such a long period of time. And that's going to go on, that as we continue to innovate, as the markets continue to innovate, as new asset classes continue to emerge, our commitment is to continue to update Apollo Academy with the latest educational materials.
Well, let's move to innovation and the kind of future. And I'd like to weave in an AI discussion here, because we talked about robo-advisors taking over maybe some of the wealth segment. What role do you think a large diversified financial group like Apollo will play going forward? How will you continue to innovate? And what will you see? Maybe will you respond to these robo-advisors, or do you see that that is a real risk among the wealth industry?
Yeah, I would say that we have all different types of advisors. So from our standpoint, we're the manufacturers of the respective strategies. So I think that you're going to see a whole host of advisors around the globe. Some might use AI, some might use AI in different ways. But ultimately, at the end of the day, at the core, what we want to be known for is a leader of the building blocks to go into those asset allocation models. And that's what we're starting to see, that when you look at our journey, and as I mentioned, we have strategies from credit to real assets to that of equity and equity replacement. We want to make sure that we have institutionally managed building blocks for clients that are available for clients of all different suitability levels and all different income levels. But I'll give you another example, if I may, when I think about AI and some of the excitement within asset management, which is I could see a world where you're seeing like blockchain as an example and just different ledger systems being used to fractionalize positions, whereby this fractionalization will allow for clients to be able to consume strategies more easily, number one. Number two, this fractionalization should allow for clients to build model portfolios and provide even potentially secondary liquidity. So I can see a world whereby on one side of the ledger, you're finding that people are using asset allocation models through AI, and we will be more of the parts provider. And the second side of the ledger, I could see model portfolios becoming just a bigger part of the overall market, whereby ledger systems and fractalization is going to be a much more meaningful part of that.
A fascinating, brave new world, which is somewhat daunting at times, but I think definitely on its way with the advent of new platforms, etc. Do you see the use of alternative products coming more mainstream with the clients that you work with?
100%. And the rationale behind that is to one of my earlier comments, which is in a world where classic public stock and bond portfolios, also called the 60 portfolio, is not going to potentially work in the same fashion. Alternatives is a way to provide different risk within a broader portfolio. So let's just think about it. And let's go through a couple of examples, which is if you just think about the S&P 500 in today's environment, you have 7 to 10 names that are driving 35% of the return of the index, number one. Number two is those names have an average PE of typically north of 50 in today's environment. And those indices are super, super concentrated. And then last but not least, when we think about adding different risk to a broader portfolio, over 80% of companies are private now versus public. So when we think about how can clients build better portfolios from an asset allocation perspective, the classic allocation to just public stocks and bonds, you have much more correlation, you have more volatility and potentially lower return streams on the go forward. We believe that alternatives is a must as part of that overall allocation. And we could see a world where client portfolios can have 25 to even up to 50% of their portfolios in alternatives. Now, that's going to be a journey and it's not going to be an instantaneous movement, but we do believe that alternatives will become mainstream. Number one, because client portfolios need to have it to try to generate returns like clients are accustomed to, number one. Number two is in today's environment, unlike the past, there are a lot more structures that allow client portfolios across the spectrum to be able to purchase alternatives. Like I'll just give you one example. We have a few strategies on our platform today that if you have $2,500 in a taxable account, you can now gain access to institutional quality alternatives.
But times have certainly changed. I'd like to go back to some personal reflections now. So you've had a long career at this point and it's taken you through two well-known institutions, takes you around the world. When you look back at the course of that career, the course it took, were there any setbacks or challenges in there or lessons learned that shaped you into how you see the world today?
I would say you can't be afraid of failure. As we think about innovation and product development, and we think about just creating cutting edge strategies on behalf of our clients, you could have some of the best ideas, but they might not come to fruition. So one of the things that I've learned on a global wide basis is not to be afraid of failure, and you have to embrace it. And what I mean by that is you need to understand that if you failed, what is the rationale behind that failure so you don't do that again, and you got to learn from that. So overall, when I think about 2 decades plus of innovating, creating structures and strategies for clients around the globe across both institutions, I would say that's probably the biggest item.
It's a really interesting point, failure, in terms of product failure, because we do have this endemic survivorship bias in here when we're looking at the products around us. We hear a lot about the ETF wave and massive amounts of ETFs being launched, but we kind of don't see the number of ETFs that never get off the ground or never get out of the gates or never get to critical mass. And similarly, with products that don't work, we don't see the graveyards almost because we're so busy looking at what's out there. So if you were to say, look at any kind of examples of, maybe not from your own experience necessarily, but just in the business of products that were the wrong place, the wrong time, or that misjudged the market. And I'm thinking alternatives in particular, because the democratization of alternatives is not a new idea, but it does appear to be getting it right this time. It's been tried in the past and it perhaps wasn't well set. So any kind of observations, the lessons learned from the product history or the product development history map?
I'll share with you an example of one personal failure that I've had, and then let's bring it to alternatives. So back in 2004 and 2005, I was looking to create a strategy of enhanced yield or enhanced income. And we thought that one of the most scalable ways to do it was to take different strategies, put them into a fund, and it would be more of a fund to fund for like liquidity management. We did it. And then after around 12 months, the performance was excellent. The marketing I thought was top notch, but it just wasn't received well by clients. clients at that part of the cycle, yes, they like liquidity management. Yes, they like strong performance. Yes, they like glossy marketing, but they didn't care for a fund-to-funds approach for liquidity management. So that was an example whereby we had the right asset class, we had the right performance elements, we had the right marketing and client service, but we just didn't understand for this market the clientele correctly. And we shortly thereafter decided to close it down. And I think what's important about that is we recognize that the market has changed, or we were too soon for that market, as an example. When we look at the alternatives industry, when you look at structures and structures that allow you to democratize risk, let's go through memory lane. Mutual funds began in the 1920s. Closed-ended products for like private equity were in the 1980s. ETFs were in the 1990s. And then we think about like truly like alternative products like non-traded REITs 1.0 or non-traded BDCs 1.0 and or traded BDCs and traded REITs. That's really been in the last, call it 10 to 15 years. So overall, when we speak about the democratization of alternatives relative to its called brother and sister structures, the mutual funds, ETFs, and closed-ended, it's very, very new. And when I look at the first generation of these alternatives, first being these were traded versus non-traded product. And I think what a lot of investors found that in traded product, a lot of these exhibited equity-like risk, especially when markets exhibited a lot of volatility, which was a negative for structures like that. That's number one. I think number two is when you look at the non-traded counterparts, typically they were more levered, they had higher fees, and effectively fees were on gross assets versus net assets. So that's what I'm going to frame, if I may, as alternatives 1.0. Alternatives 2.0 is really less than 10 years old. I would say that it's probably in earnest, maybe 3 to 5 years. And when you look at non-traded REITs 2.0, non-traded BDCs 2.0, now we have all the structures like interval funds and others. The evolution is these are non-traded versus traded. So clients are really able to harvest that illiquidity and complexity premia, and they don't need to be concerned with the equity vol. That's number one. Number two, fees are much more appropriate in that they are on net assets versus gross assets. And then last but not least, the consumption of these strategies are much easier today than they had been historically. And again, it goes back to the fact that you can have great strategies, but if you can't buy them in a frictionless manner, it doesn't really matter. So I would say we're seeing that evolution, and we're just in the very, very early stages of that evolution, both in the US as well as abroad. So I would say that overall, it's going to be an amazing journey over the next 5 to 10 years. And I think you're going to see that journey evolve from structures to how clients consume these structures, to liquidity, to that of different asset classes evolving on a global wide basis.
Very exciting. Well, when you go back in your career, we've spoken a little bit about mentorship and the training that goes into making an exceptional client service professional. Were there any key people throughout your career who were mentors to you or had a particular influence on you?
Yeah, the key people in my career were either some of my managers. I've had, fortunately, a lot of mentors along the way, and even colleagues. But I would say the key people that influenced me were the people that were willing to invest in me. And these are people that generally would provide constructive feedback. And, a lot of people don't like constructive feedback, but I would say feedback is a gift. If people are willing to spend the time to give you critical feedback, they're doing that because they want to make you better. So if like from my standpoint, when I look at my career, and I'm so honored to have this journey that I've had thus far, it's really the people that have given me this feedback that I'm just so thankful to, because feedback is a gift that is everlasting. So overall, when I think about the people that have influenced me, it's the people that have invested in me. And I try to do the same to both colleagues and people that I mentor on a global wide basis.
It's interesting, isn't it? This is a constant theme that comes up with feedback and just how counterintuitive treating feedback that way is, though. Maybe as humans, we're programmed to defend ourselves and to take feedback as criticism. And I think it really does involve a mindset shift, almost 180, in order to see it a different way. But never too late, I suppose.
But it does, but you have to be open to it. Like I'll share, a story just around feedback where this is a long time ago when I used to be involved in mortgage-backed securities. One of my mentors said, Jason, we start pretty early, but if you'll meet me every Monday at 4:30 at Starbucks, we will spend 2 hours every single Monday. I'll teach you as much as I can about mortgage-backed securities. Like I was thrilled by someone taking the time, willing to invest in me. And then throughout the course of the week, as I potentially might have messed things up along the journey, this person would pull me over to the side to say, Jason, this is what you've done well. These are the things that you could do better. And it was that open stream of constant communication. And this is a person that, though I haven't seen for a long period of time, I think about them often. And I also apply this level of mentorship to my population of people that I am fortunate enough to manage in today's environment.
Extraordinary. I do think those type of gems in our career are unfortunately few and far between, but great that you had one. 2 hours seems like a lot of time, but that is really great. Last question is around any creed or motto that you live by, or maybe any advice that you would have for your younger self, that student, finance and entrepreneurship, anything that you know now you wish you had known then?
Work hard, build strong relationships, and continue to re-underwrite what you do, because given that this is the most dynamic industry in the world, things change. So what might have worked a couple of years ago might not work today. So my advice would be continue to re-underwrite it to try to make it better. And then last but not least, have fun. You're going to meet a lot of interesting people. You're going to learn about a lot of different markets and just enjoy the journey.
Well, thank you so much, Jason. It has been a great journey through the evolution of the product and solution building landscape. Nobody dislikes a solution. I think a solution gives a great sense of completion and comfort. And I think it's really great to understand the creativity that is involved in such a role. You've given us a few rules of three, I think 3 by my count here throughout this podcast. So thank you so much for coming here and sharing your insights with us.
Pleasure. Thank you so much.
I'm Aoife David. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.